Income Tax 2020. Schedule C Sole Proprietorship Inventories. Come in, relax with Income Tax 2020. Sole Proprietorship Schedule C Business Inventories. When thinking about our income tax equation, we're going to be in the top line item in the income line item when discussing a Schedule C or sole proprietorship business, noting that we do have a separate Schedule C, that separate Schedule C having both income and expenses on it, basically the net income of it, then roll into the top line item of our income tax equation, where we then apply out our above the line and below the line deductions. So here's going to be our Schedule C. Remember that it can have impacts on multiple areas of the tax return, including this line on the income line on the 1040, the income line, which is coming from the Schedule C, which is going to the Schedule 1 Part 1, and then here. Then we have the self-employment tax, which also half of that then can be deducted as an above the line deduction, which would be on Schedule 1 Part 2. We have the qualified business income deduction possibly here as well, so many factors could be involved with the Schedule C. Here's a look at the Schedule C. So we have the Schedule C business, we've got the inventory or the income up top, expenses down below, the net income. Now notice here we have chosen a cash method just by checking the cash box. If you have inventory, however, it's more likely that you're going to be required to basically have an accrual method, or possibly may want to have an accrual method given the fact that tracking inventory on basically the balance sheet is basically an accrual type of thing, typically, and that's one reason the IRS may, in some circumstances, require you to deviate from a cash method if inventory is involved. With regards to the Schedule C, note that because you have inventory, it doesn't mean that you're going to report basically the inventory on like a balance sheet on the tax return, because note the tax return only has a Schedule C, which is basically an income statement. However, you do have Part 2 here, which is the cost of goods sold calculation. So the cost of goods sold formula is something that you're going to have to fill in if you're dealing with inventory. And the formula for cost of goods sold, if you look at the standard accounting formula, is basically the beginning inventory plus the purchases, the increases to the inventory, minus the ending inventory. That's how you're going to calculate the cost of goods sold. So you have this added field basically that needs to be populated for inventory. So two things that are going to be impacted for sure with inventory. One, you're probably going to be choosing, more likely to choose at least the accrual method, may be forced to choose the accrual method. Again, if it's a tax return that you've been doing in the past and you're continuing to do that, the decision as to what method to be used will probably already have been made, and you're just going to mirror what happened in the prior year in the current year using the consistency principle. And then you're also going to have then to deal with the calculation for cost of goods sold. So you might have basically an income statement, for example, which already has the cost of goods sold on it, right? You might have an income statement basically that has, cost of goods sold just as an expense line item, but you're also going to need to basically do and back into possibly the cost of goods sold calculation using the cost of goods sold worksheet. This is on Part 3 of the Schedule C. So we'll talk about this in a little bit more detail. Remember that this is coming from the Tax Guide for Small Business. Although we're looking at the Schedule C for 2020, the guide is only out for 2019 now. So we might have made some modifications to adjust for 2020, but just realize, of course, that if you have questions about the nuances of anything, if you have a gray area, then you want to take a look at this. It can be found on the IRS website, irs.gov, Tax Guide for Small Businesses, and then you can check out, hopefully the 2020 version will be out shortly, but it should be much the same 2019, 2020 for inventory. So generally, if you provide, purchase, or sell merchandise in your business, you must keep an inventory and use an accrual method for purchases and sales of merchandise. So basically the inventory, the IRS is saying, hey, look, if you do inventory, we're more likely to force you basically to be using an accrual method, because basically inventory is kind of like an accrual type of activity. If you were not to use an accrual method and have inventory, then it could greatly distort your income and expenses just by the fact that you're holding on to the inventory. And that's a difference as to when the payment is basically taking place or when the inventory is sold. So there's an exception for small business taxpayers. If you are a small business taxpayer, you can choose not to keep an inventory, but you must still use a method of accounting for inventory that clearly reflects income. If you choose not to keep an inventory, you won't be treated as failing to clearly reflect income if your method of accounting for inventory treats inventory as non-incidental material or supplies or conforms to your financial accounting treatment of inventories. If, however, you choose to keep an inventory, you generally must use an accrual method of accounting and value the inventory each year to determine your cost of goods sold in Part 3 of Schedule C. So again, typically if you have inventory, if you have a substantial amount of if you're holding on to the inventory, then of course you got to record the inventory as basically an asset. That's a deviation from the cash method, and then they want you to add that cost of goods sold calculation with the Schedule C. Now, if you have inventory, like you sell things, but it's kind of like a just-in-time system or something like that, meaning you're not really holding on to inventory, although you're selling things, you're basically not holding on to the inventory in essence, then possibly you could have an exception given the very short time that you possibly have inventory. You're not buying inventory, putting it in like a store or in a warehouse and then selling it and holding on to inventory at a long time. Possibly you're doing a just-in-time type of sales process where you're kind of the middle person and therefore you're not holding on to inventory or something like that. In that case, possibly then there could be a deviation for the inventory because you're not really tracking the inventory. There's not a big delay in timing between when you purchase the inventory and when the inventory is sold. So small business taxpayer, you qualify as a small business taxpayer if you A, have average annual gross receipts of $25 million or less for 3 prior tax years, and B, are not a tax shelter as defined in Section 448D3. If your business has not been in existence for all of the 3 tax year period used in figuring average gross receipts, base your average on the period has existed. So they're trying to do an average of 3 years to calculate this. Obviously, if you don't have your business open for 3 years, you can't take 0 as an average or something like that to average in. You got to take the average then of the 2 years. And if your business has a predecessor entity, including gross receipts of the predecessor entity from the 3-year tax year period when figuring average gross receipts. If your business or predecessor entity had short tax years for any of the 3-year tax periods, annualize your business gross receipts for the short tax years that are part of the 3 tax year period. See publication 538 for more information there.